I'd like to emphasize on why you should max out your retirement accounts today. Retirement accounts rock. People want an account that simplifies estate planning, asset protection, tax reduction, investment growth, and rebalancing. They don't understand they have this account. Tax-protected retirement accounts have distinct flavors, right? Of course, you have tax-deferred 401(k)s and tax-free Roth IRAs, meaning you put after-tax money in and never pay taxes on the earnings. Their two primary flavors are those. Regardless, you're usually better off than investing in a taxable account. Not all taxable accounts are harmful. I invest mostly in taxed accounts. Over the previous 3 or 4 years, we've steadily moved goods from our tax-protected accounts into our taxable account as its share of our investments has grown. Not everything's horrible, right? You obtain reduced long-term capital gains rates. If you get qualified dividends, lower taxes apply to those. You can gift appreciated shares to charity instead of cash to remove capital gains. We addressed tax loss harvesting. These benefits are minor compared to investing in a retirement account. Please use retirement accounts wherever possible. The drawbacks are minor. As an example, the age 59.5 rule. That rule has various exceptions, notably the SAP Simplified Employee Pension, or SEPP Substantially Equal Periodic Payments rule. You can withdraw that money penalty-free before 59.5 by taking out the same percentage every year for at least 5 years. Early retirement in that way is an exemption to the 59.5 norm. There are a few drawbacks to using these accounts. Sometimes, an employer offers a bad account. Despite its bad investments and expensive fees, it's usually superior for tax advantages. We're seeing less of those. People seem to understand. Employers are realizing that they have a fiduciary duty to their employees to provide a good 401(k) plan or risk being sued. I suppose their accounts are improving. However, average doctors must comprehend why their 401(k) is so great. We fear being sued over policy boundaries. We're worried about this rare occurrence. You can preserve your retirement accounts after bankruptcy. Say you win a lawsuit. That is extremely unlikely. If a $10 million judgment is made against you, what do? You keep your retirement accounts when you declare bankruptcy. That's a good reason to max them. In addition, a 401(k) gives you an upfront tax advantage. If your marginal tax rate is 40% combined state and federal, putting $10,000 in a tax-deferred account will wipe out $4,000 from your tax bill that year. Wonderful perk, right? Skeptics will say you're delaying taxes. You get other perks, so that's not true. First, it doesn't pay taxes on capital gains and dividends like most investments or interest. The retirement account money increases faster since you don't pay taxes on it. The second benefit? There's another perk. You can readjust. Buying and selling in the account is free, right? This has no tax effects. So it's easier to rebalance your portfolio or switch investments if you didn't choose them correctly or merely need to move things about. I try to make account modifications in my tax-deferred accounts. The last benefit, which many don't realize, is that if you're an average doctor, you'll probably withdraw that money at a lower tax rate than you put it in. That's not a tax rate forecast, right? Higher tax rates don't mean you're taking that money out at a higher rate, because taxes fill brackets. I suppose the married standard deduction is $24,800 or $24,600 this year for retirement taxable income. Tax-deferred retirement accounts are likely your biggest tax advantage. The size is incredible. My partnership allows me to deposit up to $57,000 into our solo or 401(k) profit-sharing plan. I can add $17,500 to a defined benefit cash balance plan now. Being able to deduct $70,000 or even $75,000 from your salary is enormous for most doctors. That may be your largest tax advantage. It exceeds your interest deduction, charity contributions, and mortgage interest deduction. This is your greatest deduction. Today, self-employed docs may enjoy a large $199 deduction. This is pass-through business deduction. However, those are the two biggest tax reductions. If you want to minimize your taxes, save more for retirement in a tax-deferred account. The partnership plan was independent from your corporation's application. The under 50 rate is $19,500 this year. Over 50s get a catch-up contribution. If the plan allows, employer and after-tax employee contributions can make up the remaining $57,000 per employer maximum. This usually involves putting your maximum employee contribution to the hospital 401k, if you have two. Their match, a few $1,000s or $10,000, goes in your 401k. Your individual 401k has 100% employer contributions or 20% of your side business's net earnings. You can use several 401k's by putting $10,000 into your side business's $50,000. Remember those two contribution restrictions. The first is your employee contribution to all 401k's. The second is per 401k contribution. The limit is $57,000. Some plans require and allow you to transfer the money out of that account. Put it in a Roth IRA and conduct a Roth conversion with no tax cost because that maximum is so much larger than what you can put into an IRA each year. Despite its name, the giant backdoor Roth IRA may be suitable for some. It has many complex uses. Overall, that may help you put more money in retirement accounts. The backdoor Roth IRA for you and your spouse is always available. Each person under 50 pays $6,000 a year. Since you couldn't deduct the original donation, you convert it to a Roth IRA for nothing. Naturally, one of my favorite retirement accounts isn't even a retirement account. The Health Savings Account, or Stealth IRA, is great. Triple tax-free account. Money invested grows tax-protected, giving you a tax saving. It comes out tax-free if used for health treatment. If you spend the money elsewhere, you must pay taxes and a penalty. The punishment lasts until 65. You only have to pay taxes on money you withdraw and spend after 65. So it's comparable to your 401k. This is a Stealth IRA. If you have a high-deductible health plan, use your HSA. The tax-protected growth of retirement funds is so appealing that you don't want to withdraw until you have to. So anyone who advising you to withdraw money from your retirement account will likely lead to a mistake. The traditional advice is not to withdraw the money from the retirement account now to avoid a lot of taxes later. To avoid taxes on retirement account withdrawals, Roth conversions are the solution. Before we wrap up, if you've enjoyed this video and found it helpful, please take a moment to subscribe and give it a thumbs up. And for more great content, don't forget to check out the in-screen video right here. Thanks for being an awesome part of our community.